Roughly $7.5 trillion changes hands in the global currency market every single day, making it the largest and most liquid market on the planet. That means a single sentence from a central banker on a Wednesday morning can shift the value of your salary, your savings, and your supermarket shop within seconds. Welcome to your currency market analysis for the 17th of June 2026. Today we are unpacking what is moving the pound, the dollar, and the euro right now, why it is happening, and crucially where the smart money thinks these pairs are heading next. Whether you trade Forex, run an import business, or simply want to understand why your holiday money buys less than it used to, the next 10 minutes will give you a clear, grounded picture rather than empty hype. To understand any currency move, you first have to follow the interest rate story. In mid-2026, the major central banks remain the single biggest driver of exchange rates. The U.S. Federal Reserve, the Bank of England and the European Central Bank have all spent the past 2 years wrestling inflation back towards their 2% targets, and the pace at which each one cuts rates is what creates the gaps that traders exploit. The core principle is simple: money flows towards higher, safer yields. When one central bank holds rates higher for longer than its neighbors, its currency tends to strengthen because global investors park their capital where it earns more. This is why every speech, every set of meeting minutes, and every hint about the timing of the next cut sends ripples straight through the market. Let us start close to home with the pound. Sterling's fortunes hinge heavily on the Bank of England and on the health of the UK economy. Two forces pull the pound in opposite directions. On one side, sticky services inflation and resilient wage growth give the bank a reason to keep rates relatively elevated, which is supportive for the currency. On the other, any sign of a weakening labor market or sluggish growth raises the prospect of faster rate cuts, which tends to weigh sterling down. Watch the monthly inflation print and the jobs data closely, because these are the numbers that move GBP the most. For anyone sending money abroad, paying overseas suppliers, or planning a summer trip, even a 1 or 2 cent swing in the pound against the dollar or euro can add up to real money on a large transfer. No currency analysis is complete without the US dollar, which sits on one side of roughly 9 in every 10 Forex trades. The key gauge to follow is the dollar index, known as the DXY, which measures the greenback against a basket of major currencies. The dollar tends to behave in two distinct ways. When the Federal Reserve sounds cautious about cutting rates, the dollar strengthens on yield appeal. But the dollar also wears a second hat as the world's safe haven. When geopolitical tension flares or stock markets wobble, nervous investors rush into dollars regardless of interest rates. That dual role is exactly why the dollar can rally even when the American economy is slowing. Keep an eye on U.S. inflation data and the monthly jobs report, as these remain the heaviest hitters for the entire currency complex. The euro is the second most traded currency in the world and acts as the natural counterweight to the dollar in the euro to US dollar pair, the most heavily traded pair of all. The European Central Bank's path matters enormously, but so does the broader mood of the Eurozone economy, where industrial powerhouse Germany has been a persistent soft spot. When global risk appetite is healthy and traders are confident, the euro and other growth-sensitive currencies tend to firm up. When fear takes over, the dollar and the safe haven Japanese yen and Swiss franc benefit instead. This push and pull between risk-on and risk-off sentiment is the invisible current beneath every chart, and recognizing which regime you are in is half the battle when reading the market. This is not just numbers on a screen. A weaker pound makes imported goods, fuel, and foreign holidays more expensive, feeding directly into the cost of living. A stronger pound, by contrast, squeezes UK exporters because it makes their goods pricier abroad. For businesses that buy or sell across borders, exchange rate swings can wipe out a profit margin overnight, which is why so many firms now use forward contracts to lock in a rate in advance. Even your pension and investment funds are exposed, since a large share of UK savings sits in international assets priced in dollars and euros. Currency moves quietly reshape household budgets and company balance sheets every single day, long before they ever make the headlines. Beyond the economic news, Professional traders lean on technical analysis to time their entries. The idea is that price action tends to respect certain levels and patterns. Support is a price floor where buyers repeatedly step in, while resistance is a ceiling where sellers tend to take over. When a pair breaks decisively through one of these levels on heavy volume, it often signals the start of a fresh trend. Traders also watch moving averages, such as the 50 and 200-day lines, to judge whether the longer-term momentum is bullish or bearish. The healthiest approach combines both worlds: use the fundamentals to decide your direction, and use the technical levels to decide your timing and to set sensible stop losses. So what is the outlook from here? Rather than pretend anyone can call the exact figure, the honest framework is this: expect the currency that belongs to whichever central bank cuts rates most slowly to hold the upper hand through the summer. Volatility is likely to stay elevated around every major data release, so the days surrounding inflation reports and central bank meetings are the ones to mark in your diary. My single biggest takeaway is to never trade on emotion or on a tip alone. Build your view from the interest rate story, confirm it on the chart, and always protect your downside with a stop. If you found this analysis useful, keep following along for tomorrow's breakdown, and share your own forecast for the pound and the dollar in the comments below.